Yo, what's up, everybody? It's Friday night, May 16th. I just got back from boxing, sparring session. So today was a good day. Market was up. Yesterday was a very impressive flow. Interest payment. I told you that was a quarterly interest payment. 72 billion interest income transfer on interest on treasury securities. That's huge, man. That's like last year at this time, May 15th, 2024, it was like a 60 billion interest income transfer. Yesterday was a 70, so 12 billion more. So a lot of these longer dated maturities now that are rolling over, they're rolling over with a higher coupon, with a higher interest payment. So that's just adding to these interest income flows. Now, I've been telling you guys that T-bill interest is dropping year over year. But with this I didn't do the numbers yet, but with this transfer yesterday, this quarterly, we're probably up over 30 billion for the year in terms of interest income transfers. Yesterday was a big flow day. The leading flow was like 95 billion or 98 billion. The net flow was something like 75 billion. So it was big, man. It was big. Now, one thing you got to be aware of is that, we're still under the debt ceiling, which means that these reserve additions, you had reserves are up like 200 billion in the last week. This is going to add to it by another, 70 billion or so. So we're going to be in that situation again, probably by next week, where the system is going to get filled up with reserves, right? The water crashing into the boat, and the bilge pump, which is the debt sales by the Treasury, that is not operating as normal because of, because of the debt ceiling. So we're going to have this problem again with all these reserves piling into the system. All right, so I've covered that. Now, some of you, I see that I was out at the boxing gym, so I don't know, but apparently Moody's, I love these stories. Moody's just downgraded the credit rating of the United States of America. And I got to tell you a story about this because, first of all, in 2011, S&P did this. S&P already dropped the U.S. AAA rating back in 2011. And I'm going to tell you a story about this because leading up to that, that drop in the credit rating in 2011, for years, I was saying, eventually these clueless, idiotic rating agencies, and don't forget, these are the same rating agencies. We're talking about S&P and Moody's and Fitch. These are the same rating agencies that rated all that subprime junk that blew up, those mortgage securities that blew up in 2008 and 2009. They rated all those AAA, okay? Don't forget. And I have to tell you a personal story, which is I was about to do. I worked for Standard & Poor's for a short period of time back in 2000. And I remember, it's funny because when I joined S&P, one of my colleagues over there, or another guy who worked there who had been there for a long time, he said, "Mike, this is a great place to work because they never fire anybody." And I was in their structured finance division, okay? And then I was looking at the time, one of the guys that I was working with was the head of auto credit rating. This guy's name was Scott Sprinzer, okay? I believe that's his name. And I said, you got to be, and he was giving out AAA ratings on General Motors and Ford. And I said, you got to be a little bit careful about GMAC, the GMAC, that's their financing unit with all this AAA, because it's like, they're valuing their auto inventory. I felt like higher than what it was. That was the basis of their valuation, their cars. And I said, like, if we go into recession, man, these things could blow up. And then he took kind of like offense at what I said. He said, that's not true. I'm the head ratings guy. You don't know what you're talking about. And then we had a conference, an internal conference, where some guy, I think it was it was an asset management company called America West. I don't even know if they exist anymore, but I'm talking about, this is in 2000, so this is a long time ago. This guy came to present America West, and I was an employee of Standard & Poor's. And when it got opened up to questions, I guess it was stupid of me because I was an employee. I got up to ask a question, not so much to ask a question. I was kind of pressing the guy, saying, like, because this America West, they were investing heavily in these structured finance securities. And I kind of pressed him, like, don't you think there's going to be a problem if there's a recession? Blah, blah, blah. Anyway, I got in a lot of trouble for that. The managing director of my unit, who happened to be a woman, she called me over and she's like, you work for our company. You do not ask questions. I'm like, me asking questions, I think, the guy has an opportunity to answer it and clear the air and make everybody seem comfortable or feel comfortable, because it is an investment conference. Anyway, I got in a lot of trouble. And then this guy, Scott Sprinzer, he also went to the managing director, and this guy, Norman, he's saying, like, this guy, Norman, he's saying the GMAC bonds are no. Anyway, fast forward, I got fired. All right? Remember my friend who said, nobody gets fired from here, man. So the moral of the story, you guys know the moral of the story is, like, General Motors had to be rescued by the federal government. That GMAC unit went belly up, okay? Everything I said, I was early on it, but everything I said was true. Anyway, let me fast forward to the current situation of the downgrade. So S&P did this in 2011, 2010, 2011, I forget. And, leading up to that, for years, I was saying they're going to do this because they're stupid idiots. And they don't understand the distinction between a currency issuing nation where all of its liabilities are denominated in its own currency, like the United States, and something like Greece. Remember when Greece was having a problem in 2010 where it's not an issuer of its own currency, it uses the euro. And all those European periphery countries, like, they all had problems. Greece and Italy and Spain and Portugal and all of them, right? Except for Germany. And they all had to be bailed out by the ECB, which is de facto, that's the currency issuer for the euro area. And I said at the time, if one of these credit rating agencies ever downgrades the United States, that is a massive buying opportunity for bonds. And sure enough, I don't remember where the interest rate probably back in 2006 or something, it was probably like around 6% or something like that. Not 2000, in 2011 I'm talking about. When S&P downgraded, we had a massive rally in bonds, in treasuries. These people are so stupid. They do not understand that there is zero risk in a country like the United States, which issues its own money and will never, ever, ever be in a position of insolvency, in other words, not able to pay its debts in its own money, where all of its obligations and liabilities are denominated in its own money. And just to sum up this story, I had, at the time that happened, that downgrade in 2011, I actually had an email conversation. I'm going to try to find it. I had an email conversation with the head of sovereign ratings for S&P, a woman. And I asked her, I said, don't you understand that the United States is a currency issuing nation of US dollars where all of its liabilities are denominated in US dollars? And it could never, ever be insolvent. There is zero risk. And she came back to me and said, yes, I understand that. She actually said something that makes sense a little bit. She said, yes, I understand that. But the government always threatens to do that. In other words, the Congress, with these fucking ridiculous debt ceiling, brinkmanship that we always go through. So she had a point there. They do threaten that, but that's not going to happen, okay? And the point is, for a currency issuing nation like the United States, again, I'm going to repeat it, with all of its debts, all of its liabilities denominated in its own money, there is zero risk of insolvency. That's why, when I look right now at the yield, so to speak, landscape out there globally, when you have countries like Portugal and Italy and Spain and Greece and even Germany, and they all have the 10-year yield all below the United States, it's ludicrous because all of those countries, or I should say none of those countries, are currency issuers anymore. But that goes to show you that the Fed, ridiculously keeping interest rates high, higher than what we see in those basket case European countries, it's totally ridiculous. But let me just finish up by saying this. I think it would be such a beautiful irony right now, and I hope you're listening to this still, because I kind of rambled. It's Friday. I think it would be such a beautiful irony right now if we had this triggered a giant bond market rally. I mean, this would be perfect right at a time when you got a downgrade of the US debt by these idiots over there at Moody's. I think it would be beautiful if we had a gigantic bond market rally. Now, I don't think that's going to happen necessarily because it's all up to the Fed. And I just read a thing yesterday where Powell said, we got to change our communication, because up until recently, up until the tariffs and during the pandemic, our communication to the market was about weak employment and blah, blah, blah. In other words, they were dovish. And now, because of the tariffs, we got to be communicating in a more of a hawkish tone, all right? So that's the Fed. It's all the Fed. But this is, again, this just exposes this monetarist mental illness. You got people, and believe me, these people who I was working with at Standard & Poor's, I wasn't there very long. They get paid very, very well. They're invited to all these financial conferences and stuff like that. A lot of them are asked to speak. They carry a lot of credibility because they work for the rating agency. It's bullshit. They are fucking clueless. And this is, just an ongoing example of what I talk about all the time, which is part of the problem, which is this embedded pathology, this embedded mental illness in the entire financial world of this monetarism where people don't understand. They just really, really don't understand. And this is pervasive everywhere, not just on Wall Street, but in academia, in the media, in corporate finance, everywhere. It's really a terrible, terrible thing. But I'm not in a position to change it. You know, now I've been kind of, there's been plenty of books written about don't sweat the things you can't change. I was never like that. Like, there was a lot of things I knew I couldn't change, but I got riled up about it, and I'm not doing that anymore. I don't care. I'll just make money in the markets. Anyway, that's it for today. Please like and subscribe. I noticed that the likes have been going down a lot. I don't know why, but whatever. This is not a channel or a topic that appeals to a lot of people. It's only people who are, curious and intelligent and want to learn. Sorry, but that's just the truth. It goes against a lot of deeply, deeply held beliefs, like I talked about this morning about money printing doesn't cause inflation. That triggers so many of you. You get heated, you get upset, you get pissed off when I say that. You want to attack, you want to say no. You're an idiot, you don't know what you're talking about. The price of a movie went from a nickel to whatever it is, $18. That's inflation. It's not, okay? Anyway, that's it for today. Please like and subscribe if you choose to. If you've already done that, thank you very much. And don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial to MMT Trader. Bye.